Alright, so now we've come to the overall objectives of the auditor when he's performing an audit of the financial statements under GAAS. And this is in AUC section 200.12 and 13. And this basically gives us a high-level overview of what are the objectives of the auditor in performing the audit in the first place. So what should be accomplished by him performing the audit? So first of all, we see that he should obtain reasonable assurance, and we've seen in other videos and from the introduction to this section that reasonable assurance is a high-level assurance, but in no way can the auditor get absolute assurance that the financial statements are free from material misstatement. And that's because there are certain inherent limitations to performing the audit, and those might include maybe management doesn't give you all the information you need, or there may be fraud going on at the company, something like that. So we're just hoping to obtain a high-level assurance about whether the financial statements as a whole are free from material misstatements. So we need to look at all of the misstatements that are found or not found and consider if, looking at the financial statements as a whole, are they free from material misstatement that might lead a financial statement user to alter his economic decisions based on those financial statements. And so next we see that these material misstatements could be due to either fraud or error. And we see that they're not saying that we need to find fraud or we need to find errors. We need to find material misstatements, and those might be due to these different occurrences. So our explicit goal in performing the audit, or the objectives of performing the audit, are not to find fraud, they're to find material misstatements. And so by obtaining this reasonable assurance, we should be able to express an opinion on the financial statement. And that's it. We say yes or no, they're free from material misstatement. We don't have an obligation to adjust the misstatements to their correct amounts or to even prepare the financial statements. Our goal and objective is to provide an opinion if they're perceived to be materially accurate. And that means, do they present fairly in accordance with the applicable financial reporting framework? And so this means that are all of the accounts and disclosures presented in the correct amounts and in the correct classifications, etc., in the way that the applicable financial reporting framework requires them to be. And this financial reporting framework could be GAAP, it could be a cash basis of accounting, it could be tax basis, so on and so forth. So GAAS doesn't require a particular financial reporting framework. The financial statement users and management can apply the financial reporting framework they find most useful for the users of the financial statements. And the objective of the auditor is just to say, are the financial statements in line with that financial reporting framework? And so after we've developed that opinion based on the evidence from obtaining reasonable assurance, the objective of the auditor is to report on those financial statements and to communicate according to GAAS. So the report on the financial statements would be the opinion report, where we say yes or no, they're free from material misstatements. But there also may be communication requirements, for instance, communications to management or communications to those charged with governance regarding the conduct of the audit, and also maybe some internal control improvements that could be made with the accounting staff and with management. So the objective of the auditor is to prepare all these reports accurately based on the auditor's findings. And so basically, according to the or to do with the opinion reports, there are basically three reports that can be used when providing the opinion of yes or no the financial statements are accurate. And AUC section 700 provides a more detailed description of those reports. But from a high level, you can provide an unqualified opinion. That means that we found that the financial statements as a whole were free from material misstatements. So we could also provide a qualified opinion, which would say the financial statements as a whole are free from material misstatement except X. And that's commonly called an except for report, because we're saying there were no material misstatements except this one. And so finally, the last report might be an adverse opinion, which might say that yes, the financial statements, no, the financial statements are not free from material misstatement as a whole. And finally, if the auditor was not able to obtain reasonable assurance on the financial statements, he might disclaim an opinion or withdraw from the engagement. And this would mean that he was unable to get enough evidence to decide whether they are free from material misstatement or not. And in that case, he just doesn't make an opinion at all. And hopefully that comes about in very rare circumstances.